Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50 year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
We're going to kick this thing off, and today's session is about financing properties when traditional banks say no. And those traditional banks could be the bank that you've been with forever, the Bank of Americas of the world, the Chase Banks of the world. Back before I really got deep into real estate, I used to think that those are the banks that you would go to get financing. And I have learned very quickly that that's not who you want to go to. I much more favor mortgage brokers that work with a lot of banks and or credit unions that may be attached to your workplace or that you bank with locally. I think those are some of the best ones you can go with in terms of financing terms and actually looking out for each other. Now, most people think that a no from a conventional bank, like one of the ones I just mentioned, means that the deal is dead. I'm here to tell you that it's not. Banks are one lane on a multi-lane highway, and tonight we're going to walk through 5 financing paths that don't depend on conventional approval to get done. And so the 5 we're going to talk about today are DSCR, hard money, seller financing, subject to, and partnerships and private money. And I have actually done a good portion of these and helped clients do at least all of these, actually. And so this is going to be a good talk to walk through this. And so first, we're going to dive into DSCR loans. And so DSCR is the debt service coverage ratio loan. And it's something that is very familiar when it comes to commercial projects, right? So if you're buying something that's 5+ units, or you're buying something that is like a retail operation or storage or things of that nature, this is typically the type of loan they're looking at because they know if you're going to go buy a whole storage facility, you're not going to be the one that can cover that. They're not going to look at your W-2 as like, hey, can you pay for this thing over time? They're going to look at your overall debt service coverage ratio, right? For, hey, well, how much income is this property bringing in? Or what is the projected income that this property is going to bring in? And can it cover the mortgage plus some? Typically, they want to see a minimum of 1.2 coverage, meaning if the mortgage is a 1, it's 0.2 over covering the mortgage. So you have a little wiggle room there, but they're definitely going to want to see some reserves as well on that piece. Now, when it comes to DSCR loans, especially in the residential space, they've gotten popular over the past few years. This does not mean that you can just have any type of credit and get a good DSCR loan. Ideally, you want to have a minimum of 620. Ideally, a 680 or 700 plus will get you into better DSCR loans because there's some where it's a DSCR loan, but you got to put down 25%. And there's others where if you got excellent credit, you can put down as little as 15%, depending on the type of property you're buying with that debt service coverage ratio loan. And so that's the DSCR. For buy and hold investors who don't show enough personal income on paper, this is a good one. And so myself, right, I've now moved into the 1099 world and I tend to write a lot of stuff off. That's one of the benefits of being a full-on real estate investor, right? And so DSCR loans as well as bank statement loans have been what I've leaned into over the most recent couple of years. Number 2, hard money. So this is really based on the asset itself. They don't look at you too much, except if you have a history of working with your hands or being able to handle these type of flips. That's going to help you on this. But when it comes to hard money, you're going to put down a little bit more than you expect. People think that, hey, I'm just going to get all the money from this investor. No, that investor needs to protect themselves as well. So typically, especially if it's your first hard money deal where you're doing like a flip or a burr, and that's what this is used for, right? And let me take a step back. When you're doing a flip or a burr where you know it's going to be a short time period of like 6 months or so, that's when hard money comes in. I've had some newbies come to me and say, hey, I'm thinking of buying, a portfolio of properties that I want to just make long-term rentals. They're already renovated and I wanted to use a hard money loan to get it. That is not ideal because a hard money loan is not supposed to be held for a long time. If interest rates right now for a conventional investor are at 7.5%, a hard money loan is going to be anywhere from 12 to 15%. And it's going to have a time limit on it before you have to start paying penalties and other points. And you got to pay points up front. It's just a very expensive loan. What it's used for is to get in and get out, typically on a flip project or a burr project where you can refinance it in a short time period. I'd say that time period is ideally 6 months or less, or maximum a year on a hard money loan. But when you talk about using it, it's great for homes that would not qualify conventionally. It's great for a house that we just helped the client do. We just helped the client do a BRRRR, which is a buy, rehab, rent, refinance into an STR for a luxury STR, and this house is fire. When we were running the numbers up front, we were able to get the house purchased for 450, even though it was listed at like 550. We got it at 500, negotiated down to 450 during due diligence, and I had the comps coming back at around the 850 range. If we put 200K into it, and we were good with that, they did a little bit more. They probably put like 250, maybe like 275 into it to do even more features. And this home came back not at 850, but at 1.15 million. And so they successfully completed the BRRRR, pulled their money out, and now have powder that's dry to use on the next deal. And they did an excellent job on this property. And now they got basically a brand new property. And so that's an excellent use of the hard money where you're able to refinance and do it into a BRRRR. And that's what you would use it for, because they give you not only the down payment or the rest of the down payment, because you're putting down 20%, they give you the rest, and they give you draws to actually do the full fix up. Okay, number 3, seller financing. This is something that's a huge buzzword. I know that there's a lot of teachings out there that show people how to do seller financing, and one that comes to mind is like the Pace Morbies of the world, right? Where they have like the subject to and things of that nature, which we'll get to. But seller financing is really valuable when the seller owns the property outright and when you're in an environment like we are in right now. A lot of sellers still believe their home is, hey, it's at the value that it peaked at back in 2022, and they're not willing to come off of their price. And if they own most of it or own it outright, they don't have a lot of pressure to. They could just wait this thing out. And so this is where seller financing can come into play. If you come to them with an offer and say, hey, I'll put X amount for a down payment, as long as you finance the rest, you can make a deal happen in this environment. And you can make a deal happen to where it's not going to hit you as much as going out and obtaining a loan right now. Because right now, if you were to go get, a conventional loan, you're looking at 7.5% roughly for an investment loan. And that's pretty high, right? And so, well, compared to what we're normally used to. And so with seller financing, you can get something as low as like 3%, 4%. It's really whatever you negotiate with the seller. Now, the caveat with this is it depends on how sophisticated the seller is, what they're going to negotiate. Typically, you'll get a lower interest rate. Sellers are going to want to negotiate a higher down payment because they want to get some cash right now. That's why they wanted to sell this whole thing. And so have a conversation with them on that. And then the term that I usually try to get is based on where we are in the market. I would try to get about 36 months to 60 months of where you can just pay on that seller financing note, right? And at any time during that, at no penalty, you can refinance and go and get a loan from the bank and wipe out the rest of the seller finance. This is one way to do it. We actually were contemplating doing that on the storage property that we purchased, and the seller was open to it. They just were pretty sophisticated and they were older, and they were asking for like 7%. And we were like, no, we're not doing that. In interest. And so we ended up just going to the bank and getting like, a comparable loan to just get them out of it and have full control. So that's seller financing, which is number 3. Number 4, right? 4 of 5 is subject to financing. And this is when the seller still has a significant loan on the property, right? But they're trying to sell it and they're not getting the number that they're looking for. Ideally, it works if that seller just wants to get out of the deal, right? They're a little more open to go on this pathway, or if they have equity in the deal and they trust you to be able to execute on this. And so I actually have completed one of these myself. I did it back in 2024, and it was with a short-term rental that we were already managing. This owner had bought a bunch of properties to flip. And as we know, the market kind of turned back in 2023 when interest rates were so high, and it started to really drive down values. And this was in a fringe neighborhood. It wasn't an A or a B plus neighborhood where the values would stay up. It was something like a C plus area where the values really fluctuate, especially when the market starts to get a little bit shaky because people aren't banging down the door to be in that neighborhood. And so the numbers were basically break even for him. And when there was fixes that came in, that came out of his pocket, because he was paying us the 20% management fee to be fully hands off. And so when you look at that piece, he was fully hands off, right? And that was awesome, but he wasn't making any money. And anytime something happened, it was like, okay, this is more money out of pocket, more money out of pocket, more money out of pocket. And so what we ended up doing is we did a subject to deal with him because he had it on the market for close to a year. Like he tried to list it himself because he's licensed in a different state. He said, you know what? I'm going to save on the cash and just list it myself. So he did that. And long story short, it sat and he wasn't willing to take less. And so we were open to giving him his asking price if he gave us the terms. And so essentially we were able to get in this fully furnished, no down payment, right? We just took over the payments and then that management fee became our profit. And we put probably another 6 to 8 grand into the property itself because he wasn't willing to do this, but there were some updates that could be made to just make it stand out a little bit more. But it was a 3-bed, 2-bath property, which is not something we would go and buy on the market, right? We absolutely would not. Ideally, in the Metro of Atlanta, you want to go bigger or go super small and make it unique. And so we took this one over subject to, because we didn't have to put any money down. We just did a couple updates and we were able to boost a bit of the cash flow. And we put it on a 36-month deal to where the equity that we owed him, which is probably like 50 to 60K or so above the purchase price, above the loan that existed on the property, which we had already taken over, is what would come due in a balloon payment in 36 months. We didn't have to make any payments in between then, as long as we just paid the mortgage, and that would be a balloon payment. And so now in that 36-month time frame, we have the opportunity to figure out when the best time makes sense to either sell it or refinance it and then use those funds to pay him out. And then we have the property and kind of go from there. And so the mechanics of this are you typically have to have trust with that seller, right? Either an established relationship from before, you got to follow up with them a lot. They're typically not going to do this with somebody they just met online, right? Unless you're highly convincing. But subject to is a way that you can get a couple of these properties as well. And I actually know a couple investors down the DMV area that this is their whole strategy. They went through a couple camps and they crushed the subject to. And the fifth and final one that we're going to go over today is partnerships and private money. Okay, so I've actually done both of these as well. When it comes to the partnerships, right, there's many things that you can do in real estate. And with the partnerships, your partner could either help you bring capital, they can bring the operations expertise, they can bring the credit to the partnership. It really depends on what you need. And so one of the properties I purchased, it was my second deal actually in 2018, is I bought a 12 unit, right, which is a commercial loan. It was actually 3 quadplexes that were right next to each other. And this was down the block from the first triplex that I bought. Like literally you could take, a 2-minute walk, boom, boom, maybe 3 houses down and you'd hit all these houses, these quadplexes. And it was for 500K because these things needed some work, right? I purchased it and immediately had to put in close to 30K of work in replacing roofs, doing structural updates. The crawl space was super tight. It was like 24-inch crawl space and it was supposed to be a lot bigger. And so guys had to go in and dig it out, redo some structure, put vapor barriers down, get mold out of there that was starting to seep into the living spaces and get it going. So that's why I was being sold for that. But long story short, I didn't have the down payment at the time. I thought I had some deals that were coming in, but they just kept getting delayed. And so I actually partnered with a family member who brought the capital, at least a good portion of the capital. I combined with that and we were able to purchase this deal and we're off to the races to kind of make it happen from there. And so this is one of those pieces that we work through, right? That you kind of can work through from a partnership standpoint. There's many different ways to structure it. Now I have partnerships on the storage, right? Where it's an even partnership where we're both bringing the money, both bringing the expertise and kind of making that piece happen. And I do partnerships across the board. I love partnerships. I treat partnerships like a marriage. You really need to know and trust that person, like and trust. It can't just be something that you do willy-nilly, like, hey, this is my friend from grade school, haven't talked to in a while, but back then he seemed like a good guy. Let's go ahead and partner. No, you need to understand how each is going to act. And I'd recommend taking it a step further and jumping on a call with partnership attorney or somebody who's going to work on the operating agreement, the LLC, and have them ask you guys the questions that need to be answered, right? Almost like going to premarital counseling. Highly recommended. You want to get these things out of the way up front, as opposed to coming back later and having missed expectations turn into a lost friendship. And then finally, the private money piece. This is one where if you have the deal, right, that you're looking for, and it's one that you need the funds to make it happen, you absolutely can just go for a private money deal. And this is where you can offer that person maybe a better return on their money than the market can do. And so we had the townhome project going on in Louisville, and this was essentially what we're going for. It's like a partnership, but it really was private money up front to be able to actually get this thing going and build it from the ground up. And you can do this in many different formats. But if you have somebody in your network that has money sitting on the side that they're looking to put to work, a private money deal could help. I've actually lended on a lot of deals, private money, where I didn't have equity, and the return that I was getting was, 15, 20%, 10%. And I was like, okay, as long as the return is higher than what I'm getting in the market right now, I'm good with it. And what I was using to lend on my private money deals for others was a HELOC. And the HELOC, I think at the time, was at like 6 or 7%. And so I just wanted to make a certain premium over that, call it 10%, right? And if I was making 10% over that, I'd just pull the HELOC, give the private money, and then get the money back, pay off the HELOC, and boom, we're off to the races. And I just made money on essentially borrowed money, which is kind of cool. And so those are the 5 that we're going to talk about. Again, if you want to talk about any of these live, feel free to go ahead and go to ekabohome.com and book a consult on the Ekabo Home Team's calendar. I appreciate everyone who joined live, as well as those that are going to join in the future to look at it. And I hope everybody has an awesome Wednesday.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.